Joining us of Baltic Capital Markets. Kathryn, happy Friday. Nice to see you. We are seeing a little bit of nibbling on stocks has been the case this week. You know, we talked about all-time highs for the S&P. It was pretty slow and steady in getting above the May high. What's been your general sense of sort of the trading themes over the last few weeks?
Well, John, I just think it's spectacularly entertaining that on a day that U.S. inflation comes at 5.0%, the highest in more than a decade, that you have the Treasury yields dropping rather than increasing, and you have equities touching record highs. That to me says that the market is completely 100% discarding all of these inflationary pressures as nothing less than completely temporary. So there is no structural inflation here. It's all completely attributed to transitory factors. And the market is once again lending full credence to the words of the Fed. This can go very, very well, or this can go very, very wrong if in fact inflation is more enduring, or if in fact some of the pressures are not just transitory in nature, but rather structural.
And you can take an ego hit, too. I mean, we talked to Bloomberg's Cameron Christ. I mean, you could have been making some logical bets going back a month and a half ago, and it stings a little bit, I imagine, if you feel like, you know, the trade is not going your way. So where do you come down on this? I mean, do you see the inflation story as transitory or not, and how are you positioning as a result?
You're right on that, John. And we have some institutional clients that say, hey, look, I understand the inflation story, but it hasn't worked out thus far. In fact, if you're long floaters, then you've been on the wrong side of the trade. If you're long tips, it hasn't quite panned out yet. So certainly there's a big component of this that is transitory in nature. My suspicion, however, is that we're going to see the structural component, which comes from a closing of the output gap here in the United States. So we have an output gap that, because of the pandemic, is still wide, which means that we still have further to grow from an economic perspective to incite those inflationary pressures. That output gap, John, is going to close by the end of this year. And at the same time, while we have 6.5% growth, remember in Q1 was 6.5%, my forecast for U.S. growth this year is also 6.5%. That's enormous. It's far greater than the 2.4% potential growth we have. You have a combination of a robust economy. You have a combination of emergency measures that are ongoing, even though we're really pretty much out of the crisis. I would say. I think that's going to show its head in the 12 to 18-month horizon. So yes, we do have structural component. It comes from the fiscal and monetary stimuli and a closing of the output gap and a robust economy. And we expect that to come on board in the next year and a half. So my view is to position your portfolios today for what we expect to happen over the course of the next year and a half. There is a transitory nature. We have both shortages for microchips, used cars, new cars. Those are the things that have really been driving a lot of these price increases, shortages of raw materials, and we can't fail to mention base effects. And base effects, John, are going to roll off as soon as July of this year, because of course last year, April, May, June, July, the economy was de facto closed. So after that, we're going to get a deceleration in the big numbers. The 5% is going to come back down to like 2.5%, 3.5% by year end. But my suspicion, John, is that over the course of the next year, 2022, we're going to get a resurgence in inflation, and that's the real deal.
Okay, really helpful context. I love that you laid out the full story. You know what it made me think of? It made me think of gold, which we haven't spoken a lot about on the morning program in recent weeks, because I guess we've been talking about the stock market move and the bond market move. But the fact that last year you saw gold prices, you know, push beyond $2,000, and then that trade lost momentum. And then early this year, it was starting to pick up momentum again. And then that got thrown away. And I look right now at the gold price, and I think about the same narrative we're seeing with the 10-year Treasury yield. And I know that you're generally optimistic on the outlook for bullion.
I am, just because, you know, it's traditionally an inflation hedge. So why not have an allocation there? I think that the most prudent way, John, for an investor, big or small, to manage their portfolio is to have it as diversified as possible and incorporate in that assets that have low correlations. Because really, the Fed is really boosting everything, right? You have venture capital, you have SPACs, you have real estate, you have everything is really quite overvalued. So what I'm looking for are assets that have a lower correlation to the traditional public equity and debt markets, such as even cryptos or areas that are a good inflation hedge. Sectors such as materials, such as utilities, such as staples, sectors that can pass along these costs effectively and outperform in an inflationary environment, a real structurally inflationary environment, as well as gold, you mentioned, alternatives that have low correlations, commodities, something that banks on a trend weakening in the U.S. dollar, which is my firm conviction, John. I think the U.S. dollar is going to be in a trend weakening growth for the foreseeable future as the U.S. not only doesn't retrace the $6 trillion or 30% of GDP spending that it's done over the past 12 months, but adds to it, right? Adds to it. So that $6 trillion that was for COVID stimuli is simply going to become massive social spending. And I know this because not only are we not talking about maybe using the funds that have not yet been deployed for the crisis, maybe for other things such as infrastructure, but we're talking about additional spending. And most of it is deficit financed. So one can bet on the dollar going weaker, and that is additive for inflation, but it's also a good thing to keep in mind from the perspective of your portfolio. Don't be 100% risk on. We need to have some defensive positions here.